Hey everyone, today I would like to probably talk a little bit about financial layer for stable returns and how we are making it at Resolv. Probably before that, it's worth to quickly introduce myself. I'm one of the founders of Resolv, CTO. Previously, spent many years in different financial services, including traditional one and crypto one. And if to probably address the point, and I will explain it deeper and deeper with every slide. So crypto obviously a very attractive source for different returns, and here just some indicative numbers, probably a bit outdated. 20 billion market is staying untapped. If you would like to probably I don't know, invest into different crypto opportunities, and that 20 billion is just indicative of open futures market interest on major crypto assets such as BTC, Ether, and maybe Solana, if I'm not mistaken. So basically, such yields might be coming from different sources, especially if you're talking about stablecoins, which is a popular trend nowadays. It can be different types. It can be RVA-based stablecoins. It can be CDPs. It can be algorithmic stablecoins. And the more complicated logic becoming here, or the more comprehensive strategies you're using, the more risk you are taking usually. What we are doing basically. From one perspective, we can concentrate on only one, let's say, yield source, or on one, I don't know, strategy, something like that. But in that case, you are being exposed to I don't know, any issues associated with that. I don't know, counterparty's risk, or it's not performing well from any perspective. I don't know, any black swan event happened, whatever. Everyone probably remember what happened around a month ago. So it's clearly shows that some, at least, products have similar issues. So what we are doing, we are essentially making architecture which allows to enable attach different yield sources, segregate risk into different products essentially. One of the key one in our example, but it can be, I don't know, scaled to other types of the products, is exactly stablecoin. And another one is more risky product, which is absorbing all potential risk might be happening, is a separate kind of insurance layer. And what it can give you is to, first of all, you have two products. Of course, it's more difficult to sell, for example. And at the same time, you can make multiple products which will be covered by insurance layer. Probably to simplify it a little bit, imagine regular insurance layer, many products have. I don't know, Athena, for example, it's a company which is operating in our space, but it usually just a separate insurance which teams supposed to fundraise for, take a different fees, for example, and grow over the time. At the same time, you can build it in the way that it is taking part of the yield from the main product. It is attached to it, and the thinner the layer, the higher the yield for that risky layer, because proportion is smaller. And opposite, the more demand for that risk, junior tranche, how we call it, the less interested it is to the people, and probably the reason to navigate towards less risky product. So how we are making it, and it's probably worth to get back to share a couple of challenges here. Historically, when we started, we essentially basically made the logic straight away. We started delta neutral strategy on Ethereum and with Bitcoin, hedging all of that with perpetual futures, and later on just started some lending markets for the periods of time when funding rates, for example, negative. What kind of challenges later on we found out? First of all, lending markets which we like started to use from the beginning might be not enough because like liquidity evolving, like we might need different types of the assets. Like again, funding rates might be bad, like different venues like might be not suitable for us and we need to diversify. So, but at the same time, like evolving the product and writing kind of new smart contracts, new infrastructure for half a year and like waiting for that is like not really a great solution in terms of like how quickly we can evolve the project. And as a result, we came up to the internal architecture where each of such blocks are isolated. It allows to have specific policies for like either internal team or external, risk curators or something like that. What kind of strategies, what kind of assets, what kind of venues you can use, and basically like just build one of such yield sources which can be attached under the hood to that layer. So from theory to practice. We launched all of that already 1.5 years ago. Since then, like already got a decent initial traction. Right now it is 300 million TVL with 600 million all-time high, and like a bunch of active users, it meant here, paid out more than 30 million in real yield, like using all of that. I haven't faced any like meaningful, at least direct economical impacts from all the recent events, and not only recent events. So in practice, seems like it is working. Let's put it that way. Probably one of the last one. How we are going to evolve all of that, or how it might be like fitting to the more broad and infrastructure and ecosystem, and how it can benefit. If you remember, I described you briefly that we're using delta-neutral strategies. On practice, it means that we're using like some long position in our specific case around Ethereum and BTC, and we are using like some like short or perpetual futures position. Long positions, of course, you can stake, and they're doing that. So, which means that they are like actually using validators network, which usually like depends, of course, on specific validations, providing services to like bigger customers who might be like not willing to like contribute directly in Ether or Bitcoin to validator network, but at the same time they usually have some stable capital which they would like to like still keep as stable, and they would like to potentially have some yield on top of that. So how it might work, like guys using us as yield-bearing stablecoin or yield-bearing other type of the assets, we under the hood like utilizing staking providers, essentially increasing like their staking value with added like staked versions of ETH, for example, here. Probably that's it mostly. I try to be short. So if any questions, please. Yes.
What if I take my money and go to you, Resolv, and you expand it to the several different strategies? Yes. And if one of the strategy will be with XUSD, that's
Well, let's imagine.
what I receive back. All of my money, all health or budget is what?
It depends. Probably let me quickly get back that slide. On practice, we have two products, like stablecoin and like what is market here investment products, but probably not correct one, like insurance layer, let's put it that way. And both of them are tokenized. Depends what kind of layer you're talking about. If you're a stablecoin user, you're supposed to be safe. Even like black swan kind of event happening, imagine new FTX case or something like that, or like, I don't know, any recent events, like you're supposed to be safe because insurance layers guys will be like taking risk for them and for stablecoin guys. If it answers your question. If you decide that you are more risk hungry for higher yield and you are a user of investment like insurance layer, you will like get loss.
And how you balance this?
The logic under the hood is the following, like, but it doesn't matter for us what you chose as a customer, like stablecoin layer or like insurance layer. Everything coming to the same pool. We are like hedging it, like earning on top of that. We are fixing like yield every day, like roughly, but again, it's just adjustable and distributing it approximately in the following way, like 60% coming to the stablecoins, like as a yield, the rest coming to the insurance layer, regardless of their proportion. So the logic, if the thinner the layer, the higher the yield for insurance layer, and the more motivation for you to come in. And opposite, if it's too thick, we don't really need the thick insurance layer, so the yield becoming comparable to the stable coin. And you will have like reasonable question why I have to stay in more risky asset for the same yield, right?
Thank you very much. It was wonderful. Yes.